Welcome to Invested Intellect, the place where smart minds and smart money meet. Are you tired of chasing hot stock tips and expensive investment strategies that promise quick riches, only to leave you stressed and uncertain? What if I told you that building lasting wealth doesn't require a Wall Street degree, insider connections, or constant portfolio fiddling? Today, we're diving into the timeless wisdom of the Little Book of Common Sense Investing by C Bogle, an investment manifesto that changed the lives of millions and laid the foundation for passive investing as we know it. C Bogle, the founder of Vanguard Group, revolutionized the industry by introducing low-cost index funds that have since become the cornerstone of smart investing. In this video, we'll uncover his core principles, demystify the concept of owning the market, and explain how you can harness the power of low costs and long-term discipline to build wealth without the headache of active management. Stay with us until the end, because if you're serious about transforming your financial future, this is one video you can't afford to miss. So buckle up and let's get started. This is Invested Intellect, and we believe that investing should be as straightforward as it is powerful. So let's break down the key ideas from C Bogle's masterpiece and show you exactly how to invest in a way that's both practical and proven over decades. Section 1. The core concept. Own the market, don't try to beat it. Imagine a world where you don't have to predict what the market will do next. A world where instead of endlessly trying to time your trades and handpick winners, you simply own a piece of the entire market. That's the radical idea at the heart of the Little Book of Common Sense Investing. Bogle's central message is simple: don't try to beat the market, own it. Instead of betting on individual stocks or chasing the latest investment fad, invest in a low-cost index fund that mirrors the entire market. By doing so, you capture the collective success of thousands of companies, benefiting from the long-term upward trend of the market. Let's unpack that. Historical data shows that over the long run, the stock market has returned about 7 to 8% per year after inflation. Active managers, with their hefty fees and constant trading, often fall short of this benchmark. Why? Because every dollar spent on fees is a dollar that isn't compounding in your portfolio. Bogle's argument is straightforward. By buying and holding a diversified index fund, a fund that simply mimics the performance of the market, you can tap into this long-term growth without getting caught up in the costly and often fruitless race to outsmart the market. No more chasing trends, no more guessing games, just simple, effective, common-sense investing. And here's the kicker: low costs matter. Even a seemingly small fee can erode your return significantly over decades. When you invest in a low-cost index fund, you're effectively keeping more of your money working for you. And that, in essence, is the secret to building enduring wealth. Section 2. The hidden killer. Costs. Let's talk about something that might surprise you: costs. When most people think about investing, they focus on choosing the right stocks or funds. But C Bogle reminds us that what really matters is what you keep, not what you earn. Consider this. A mutual fund charging a 2% fee might sound reasonable, but over time, that fee can devour up to 40% or more of your investment's growth due to the magic or tragedy of compounding. In contrast, if you invest in a fund with a 0.1% fee, you keep almost every dollar of your return. Bogle emphasizes that fees are the enemy of your portfolio. Every dollar you pay in management fees is a dollar that's not compounding for your future. And the truth is, most actively managed funds cannot consistently outperform the market once you factor in those fees. That's why Bogle champions the low-cost index fund. It minimizes expenses, maximizes compounding, and frees you from the endless cycle of chasing after fleeting opportunities. Remember, at Invested Intellect, we believe that every cost matters. The beauty of index fund investing is that it simplifies your life and your financial future. Instead of worrying about hot picks or market timing, you focus on a simple, powerful idea: owning the entire market at the lowest possible cost. Section 3. Index funds versus active management. You might be wondering, why not trust professional money managers to do the hard work? Well, the data speaks for itself. Studies have consistently shown that the vast majority of active funds underperform their benchmark index, especially after fees are taken into account. Active managers often try to pick winners, but the market is efficient. By the time they've done all the buying and selling, your returns get eaten up by trading costs and management fees. C Bogle's research, backed by decades of performance data, makes a compelling case: Passive, low-cost index investing beats active management for virtually all investors over the long run. Index funds aren't about being flashy. They're about consistency, simplicity, and unwavering discipline. They capture the overall growth of the market, which, despite its ups and downs, has historically trended upward over the long term. And that, my friends, is the power of owning the market rather than trying to outsmart it. The lesson here is clear. While the allure of active management might be tempting, its reality is fraught with higher costs and unpredictable results. With index funds, you get broad diversification, minimal fees, and most importantly, the benefit of compounding over time. Section 4. The role of simplicity and discipline. Let's talk about the mindset required for common sense investing. C Bogle insists that you don't need to be a financial genius to succeed. What you need is simplicity and discipline. Bogle's investment philosophy is refreshingly simple. Instead of trying to predict market movements or constantly adjust your holdings, you adopt a buy and hold mentality. You invest in a low-cost index fund and let the power of the market's growth work for you over the long term. The idea is to ignore the noise, the daily fluctuations, the sensational headlines, and the market hype, and stay focused on your long-term goals. Simplicity is your best friend in investing. Complex strategies, frequent trading, and market timing are alluring but often counterproductive. At Invested Intellect, we believe in the elegant simplicity of following a proven strategy. As Bogle famously said, the miracle of compounding returns is overwhelmed by the tyranny of compounding costs. Keep your strategy straightforward, avoid unnecessary expenses, and let the market do its work. Discipline is equally critical. The market will have its ups and downs, and during downturns, you might be tempted to sell in panic. Bogle's approach teaches you to embrace market volatility, not as a reason to sell, but as an opportunity to buy more at attractive prices. Consistent, regular investing, especially in tax-advantaged accounts, ensures that you're continually in the game, harnessing the full power of compound growth over the years. Simply put, don't let emotions cloud your investment decisions. Stick to your plan, invest regularly, and remember that time in the market is more important than timing the market. Bogle's common sense approach is about cultivating patience and staying the course, even when the market gets rough. Section 5. The importance of a long-term perspective. One of the key takeaways from the Little Book of Common Sense Investing is the importance of a long-term perspective. C Bogle reminds us that investing isn't a sprint, it's a marathon. Success doesn't come from short-term speculation or day-to-day market watching. Instead, it comes from a commitment to long-term growth, disciplined investing, and the power of compounding over decades. When you invest in an index fund, you're not trying to predict whether today's market is going to hit a new high or fall into a trap. You're simply capturing the cumulative performance of a broad swath of the market. History teaches us that, despite periodic downturns, the market has an incredible tendency to recover and grow over time. That's why a long-term buy-and-hold strategy is so powerful. At Invested Intellect, we champion the view that if you start investing early, stay consistent, and reinvest your earnings, you set yourself up for financial independence. The magic of compounding means that even small, regular contributions can snowball into a substantial nest egg over time. This isn't rocket science, it's basic arithmetic, applied with discipline and patience. Let this sink in. While the market may experience volatility in the short run, history has proven that steady, long-term investing in low-cost index funds is one of the most reliable ways to build wealth. Embrace the journey and let time be your ally. Section 6. Why the average investor underperforms. Before we dive into some actionable steps, it's vital to understand why many investors underperform. Too often, the average investor falls into common traps. They get swayed by market sentiment, panic during downturns, or chase after the latest trends. In their eagerness to make quick gains, they end up incurring high transaction costs, paying steep fees, and ultimately sacrificing long-term returns. C Bogle explains that the very reason active management exists is that many investors, and even professionals, are tempted by the lure of beating the market. But when you factor in the costs of frequent trading, the inevitable tax drag, and the penalties of making emotional decisions, these strategies rarely add up to more than the simple, steady approach of passive indexing. The average investor underperforms not because of a lack of intelligence, but because of a lack of discipline and a susceptibility to emotional decision-making. By keeping things simple and minimizing costs, you can avoid these pitfalls. It's not about being the smartest person in the room. It's about being the most disciplined and cost-conscious. At Invested Intellect, we believe that the power of common sense is the ultimate leveler. Even if you don't have insider knowledge or access to high-level research, you can still achieve financial success by following basic principles. Invest regularly, minimize costs, and stay the course regardless of market noise. Section 7. Practical steps to start investing. Now that we've covered the philosophy behind common sense investing, you might be wondering, how do I get started? Here are some practical steps inspired by C Bogle's principles that you can follow immediately. 1. Educate yourself. Read up on index funds and understand their benefits. Familiarize yourself with basic investment concepts like compounding, diversification, and risk tolerance. Books like The Little Book of Common Sense Investing are great starting points. 2. Set clear goals. Define what you're investing for, whether it's retirement, a down payment on a house, or long-term financial freedom. Clear goals will help shape your investment strategy and time horizon. 3. Choose a low-cost index fund. Look for funds that track a broad market index, such as the S&P 500 or a total market index. These funds offer diversification, low turnover, and minimal fees, exactly what Bogle advocates. 4. Dollar cost averaging. Rather than trying to time the market, invest a fixed amount regularly. This strategy, known as dollar cost averaging, helps smooth out market fluctuations and builds your investment habit. 5. Avoid the temptation to trade. Once you've invested, resist the urge to constantly check your portfolio or jump on every market rumor. The goal is to remain invested and let your money grow over the long run. 6. Keep costs low. Be mindful of fees associated with your investments, whether it's management fees, transaction costs, or other expenses. The lower these costs, the more you keep working for you. 7. Stay disciplined. Finally, and most importantly, stick with your strategy. There will be times when the market is volatile, but remember that you're in it for the long haul. By following these steps, you're not just investing, you're building a future where your money works for you, quietly and powerfully, free from the distractions of market noise and high fees. Section 8. Myths and misconceptions. There are plenty of myths in the investing world, and one of the biggest is that you must be an expert or a financial wizard to succeed. C Bogle challenges that notion. In reality, the most effective investment strategy is built on simplicity and consistency, not complexity and speculation. Let's debunk a few common myths. Myth 1. Active management always beats passive investing. As we've discussed, the majority of actively managed funds fail to outperform low-cost index funds once fees and trading costs are taken into account. Myth 2. You need to time the market. Timing the market is not only extremely difficult, but can also lead to missing out on the best days of market performance. With index funds, your focus is on the long-term growth of the market, not on day-to-day fluctuations. Myth 3. Higher risk means higher reward. While risk and reward are correlated, taking on unnecessary risk can lead to significant losses. A diversified index fund spreads your risk across many companies, giving you steady growth without the extreme volatility of high-risk strategies. By adhering to the common sense approach, you avoid these pitfalls and build a robust, resilient portfolio that stands the test of time. Remember, investing is not about chasing the next big thing. It's about harnessing the proven power of long-term growth. At Invested Intellect, we're here to guide you away from the hype and toward strategies that work. Section 9. The power of passive investing. To wrap things up, let's revisit the essence of what makes passive investing so powerful. When you invest in an index fund, you're buying a piece of the entire market. You don't have to worry about picking winners or losers because you own a slice of every company in the index. This broad diversification not only minimizes risk, but also captures the aggregate growth of the economy. The power of compounding is unleashed when you let your investment grow untouched over time. Even modest returns can accumulate into significant wealth when compounded over decades. This is the cornerstone of Bogle's philosophy. Consistency and patience yield remarkable results. At Invested Intellect, we believe in letting your money work for you, silently, steadily, and without unnecessary intervention. By removing the distractions of daily market movements and focusing on a low-cost, diversified approach, you position yourself for long-term success. Every market downturn becomes an opportunity to buy more of what you own at discounted prices, and every bull market adds to the growth of your portfolio. Embrace the ups and downs, knowing that over time, the market's inherent upward trend works in your favor. In summary, the Little Book of Common Sense Investing teaches us that the most reliable path to wealth is built on 3 simple pillars: owning the market through low-cost index funds, keeping costs to an absolute minimum, and staying invested for the long run. John Bogle's principles are not complicated, they're common sense. And by following them, you free yourself from the stress of chasing trends and the high fees that erode your gains. If you're ready to take control of your financial future and build wealth passively, then this strategy is for you. Remember, it's not about being the best at the game. It's about playing the game wisely, steadily, and with discipline. Thank you for watching this in-depth summary here on Invested Intellect. We hope you found these insights both enlightening and empowering. If you enjoyed this video, please give it a thumbs up, share it with friends who are serious about investing, and subscribe for more investment wisdom. Your journey toward financial independence starts now. Embrace the power of common sense investing and let the market work for you, quietly and powerfully. Until next time, keep investing intelligently